Greetings. My name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Friday, April 1st, and this is our monthly market monologue where we're going to be talking about the stock market's action over the last month and arguably the first quarter of the year, as well as some economic indicators that we see. And let's just dive right in. So as we are diving in, I would be remiss if I didn't once again mention the fact that I've put together a cycling team for the May 21st Victory Ride, sponsored by the V Foundation, the Jimmy V Foundation. The Victory Ride to Cure Cancer, 100% of the proceeds from this ride go directly to cancer research. Nothing goes to the V Foundation's overhead, which is pretty impressive, which is the reason why I decided to sponsor a team for this year's ride. We have clients all the time, unfortunately, that are fighting cancer. We've got, I think, 2 clients right now that are fighting cancer. So this hits home to a lot of people, and that's why we decided to do this. That said, we did set a fundraising goal of $10,000. Right now, our team has raised just shy of $2,400. So if you have the financial ability, if you like these videos, if you want to help cancer research, by all means, I'll put the link below the video, but you can also just go to www.thevictoryride.org, click Riders, then you click Teams, and you can search for Hicks & Associates Wealth Management. We'd certainly appreciate any help you can lend in terms of helping us to reach our fundraising goal. Now, so the month of March was a pretty good month for both the S&P 500 as well as the NASDAQ. This is what you're looking at right now is a monthly chart. The red line is that 10-month moving average. And so you can see the month of March was a pretty good month. And so we naturally want to ask, is the bear market over? And we could even debate whether or not it should have been considered a bear market. Let's, for the sake of argument, I'm going to consider it a bear market, and we'll use that term today. So now on the screen is the NASDAQ. So again, another very positive month for the month of March, but the NASDAQ has not quite taken over its 10-month moving average, which is very similar to the 200-day moving average. Then we break it down as far as the daily chart. This is now a daily chart on the S&P 500, and what I want to point out is that the high was back on January 4th. So this is January 4th. Since then, the S&P 500 dropped almost about 15%. You can see Russia invades Ukraine on February 24th. The market then rallied approximately 12.5%. The last 2 days of the month, we saw about a 2% decline in the S&P 500. And then I've drawn in, prior to today's session, there was about a 1% gap between yesterday's close and this 200-day average. So then we look at the NASDAQ. NASDAQ, the interesting thing was the NASDAQ high was actually November 22nd, so about a month and a half prior to the January high. So NASDAQ already was showing some trouble, which I know we talked about in the month of December and January. Well, then we get to that low. The market, as it relates to the NASDAQ, the market rallied 17%. And then the last 2 days of the month of March, the NASDAQ fell about 3%. And it is, prior to today's session, almost 2% above the 50-day moving average. So interesting to see this. Prior to the last 2 days of the month, we could consider this what we call a lockout rally. A lockout rally is where the market just marches north off of a low, and there's really no place for somebody to re-enter the market. So the fact that it has paused a couple of days, I would argue, is good. That is a good sign of, well, we'll use the term digestion of the gains. So who knows whether or not we're going to go back and retest this 50-day low or retest the 200-day average in the S&P 500. But at a minimum, this minor correction these last couple of days is actually a good sign. So what's on the screen right now is the utility sector ETF. And what I want to highlight is this white candle. Now the black candle this is a monthly candle chart. So I printed this chart after the market opened. So this is the month of April. So it's 1 day of trading. But look at the white candle here. And remember, as a recap of what a candle is showing us, a white candle is saying that the market or this particular ETF started the month at the bottom of the body. It did trade down. This is the wick, or sometimes called the shadow, and it traded all the way up to the top of this wick, but it closed the month at the top of the body. So that is a very tall white candle. The utility sector ETF was up almost 10% for the month. Good news if you're a utility investor, but not really a bullish indicator for the overall market, because the utility sector is generally considered to be a defensive holding. So if you have to be invested in the market and you're concerned about the markets, some people would argue you buy utility stocks. So we're going to come back to that in just in a couple of minutes, but that's not necessarily a good sign. Let's switch and talk a little bit about some economic indicators. This is what's referred to as the yield curve. In particular, this is the 10-year treasuries minus the 2-year treasury yields, okay? And so the yield is what the government is paying for interest on a 10-year treasury note, and what they're paying on a 2-year treasury note. So what is the interest that those investors are getting? So when the difference between those two figures goes negative, we refer to that as an inversion. And so right now the month ended really close to zero, but intraday, so in the middle of trading a couple days ago, I think it was on Tuesday, in the middle of trading, this figure actually turned negative. Now it didn't stay there, but as soon as it turned negative, I saw tweets from other money managers and market watchers that, hey, the yield curve just went negative, therefore a recession is coming. So let's talk about that, because you might see that in the news media. Historically, yes, when the yield curve goes negative, it does foreshadow a recession. It is not a perfect indicator, and it does not tell us that a recession is going to happen this year or the next 6 months. The lag time between when this indicator goes negative to when a recession hits varies widely, and you can see that on the screen. This data goes back to the late 70s, and you can see the gray bars are representing recessions as indicated by the National Bureau of Economic Research. And so you can see that the yield curve went negative in, looks like, in 1978, but we didn't actually have a recession in the country until 1980. And then again, it went negative, I guess that's still 1980, and we had another recession in 1981 going into 1982. Same thing here, that looks like 1989, but the recession didn't actually hit until 1990. So you get the idea. When the yield curve goes negative, it does tend to forecast a recession, but the timing of that recession is unknown. We don't know that. Now, I remember in 2019 when this happened, this is the point on the chart right here. So you can see it barely went negative, and then it reversed and went higher. But again, we heard the same thing in the news media and the armchair analysts. Hey, the yield curve went negative, therefore we're going to have a recession. Well, there was a lot of us that said that's a little extreme, because it barely went negative and it has since corrected. Well, now that we have the hindsight of the COVID correction that is now behind us, some people are now saying, well, that inversion predicted this COVID recession. I don't know that I can put myself in that camp, but that's what we're hearing. So right now we're seeing this yield curve barely went negative. We're already hearing the talk that we're going to have a recession. I'm not making that call. I can tell you that I see more and more that concerns me, that we are going to have a recession, but it's not necessarily just because of this one particular indicator. There's a couple of other things that we've been talking about a lot. That's inflation. Inflation is still a problem, and it is likely going to remain a problem for some period of time. That's the biggest issue right now. And if you study history, and we would encourage any serious money manager should be studying history. When you study history, you can see when inflation gets into an economy, it is actually very difficult to get it out of the economy. And now, as we talked about earlier this year in our State of the Union webinar, we are witnessing the Federal Reserve tightening. Okay, so they're raising interest rates, which is referred to as tightening. They're tightening as the economy is slowing down. That is not a good place for the Federal Reserve to be. So there's an argument that we could be witnessing, or we could be seeing in the forthcoming months, what's referred to as stagflation, where we have high inflation, but kind of a stagnating economy. We'll see what happens. This is what we would say is definitely going to continue to contribute to the risks of inflation, is the massive amount of debt that our nation owes. This is total public debt as a percentage of GDP. I've talked about this many times in these videos before, and I would tell you that historically our nation borrows money to fight some crisis. Historically, it was a war. You could argue in the 1980s we went into debt and created additional debt to fight a Cold War. You could argue that recently we went into debt to fight COVID. You can make those arguments, but historically, after the crisis passed, our nation would pay down the debt. There's only been a few years, if memory serves me correctly, there's only been a few years in our nation's history where we had no debt. We're a far cry from that today, but this is dangerous. Right now, we have about 123% of our GDP is in debt. That is a very dangerous place for us to be. So those last couple of charts, the yield curve inversion, inflation, etc., that points me to this chart here. This is a chart that I've shown so many times over the last several years, but I've got an update for you, so stay tuned if this is old hat for you. This is 1965 through 1979. This is the S&P 500, so it's the United States broad stock market, okay? And I'm showing it because in this industry, we constantly talk about clients, Mr. and Mrs. Client, you should be invested for the long haul. Well, this is 15 years. 15 years is a long time horizon. And so the question we like to ask is, what would we do if we were in an environment like that? Well, what would you think, Mr. and Mrs. Client? Would you be okay going through this type of time period? Because this is not hypothetical. This actually happened right here in this country, okay? So, full disclosure, this does not include dividends. So if you added the dividends into the chart, it would change the chart a little bit, but this is going to get across the point that I'm trying to accomplish today. If you did the math from the start of 1965 to the end of 1979, and then you divide it by the 15-year time period, you end up with approximately a 2% rate of return that you would have received on average during that time period. Now, the reason I show the chart is because the graph should help you to understand that you did not get an average rate of return. You got that rate of return in a very violent fashion, lots of ups, lots of very wicked bear markets down. That is a long time horizon that actually happened. So what would we experience? Now, historically, when we talk to clients about this, I would ask, or I would highlight the fact that, well, we have to factor in inflation. Well, I finally figured out how to show this chart and adjust it for inflation. So this right now is the same chart. Now, technically, I did add 2 more years because 1980 and 81 weren't pretty either. So now we have a 17-year time horizon on the chart in the United States adjusted for inflation. That is a long time horizon. So when we think about how we manage money for clients, we don't predict. One of the sayings that we use here in the office is, we don't predict, we prepare. So I'm not predicting that we're going to witness a 17-year time period like we saw in 65 through 79. That's not what I'm saying. What I am saying is we should be prepared. And I know for me and my team, we are prepared. We are prepared to navigate a period like this. Again, we don't know if we're in that type of a period or not. We certainly know we are in a high inflationary time period. We just don't know how long it's going to last. We don't know what the economy is going to do. We don't know what tax policy is going to do. We don't know any of that stuff. Okay? But the point is, we don't predict, we prepare. And that really governs how we make portfolio decisions. So 2 more slides and we'll wrap it for the month. So in the S&P 500, there's 11 different sectors. At the top of the chart, you see energy. At the bottom of the chart, you see consumer discretion. And I showed this chart last month. And last month, at the beginning of March, the only sector that was positive was energy. Well, now, you remember that chart that I showed you for utilities? Utilities had a really positive month of March. Well, now we see that the utility sector is actually up about 5% year to date. So it's now positive. But every other sector is negative. Okay? So this speaks to a little bit about how we look at things and how we're actually managing money for clients, because we're paying attention to this and we're going to try to navigate to those sectors and those countries. There's actually a single country ETF in a lot of our portfolios right now. I won't mention the name because I'm not trying to give recommendations and things of that nature in this type of video. But the point is that we believe in general there's a bull market somewhere. Our job is to go find it. Okay. Now, one more slide and then we'll wrap. This is fixed income or bonds. In this industry, we typically allocate or increase allocation to bonds or fixed income as a client wants to decrease risk. So if we have a client who says, I don't want a lot of volatility, I don't want a lot of equities in my portfolio, I just want something safe. Well, there's no such thing as a safe investment. There's no such thing as a safe investment. So bonds are not safe. That's why the word is in quotes on my chart. Okay, but when we look at bonds in a rising interest rate environment, we've been, again, talking about this for quite a while. We say bonds are likely going to struggle. Well, on the screen right now is various bond ETFs or exchange traded fund. And what I'm trying to show is, again, what we've been talking about is why we believe we need to look at risk differently. Because if a client is conservative, or if a client says only want to put half of their portfolio in equities and half in something that's a little bit more stable, well, does that look stable? And we would argue no. Because what's also on the screen is you can see that I've also got the S&P 500 and the NASDAQ on this chart. Can you distinguish them? You have to study the chart to figure out which one of those negative lines is the S&P 500 and which one is the NASDAQ. None of them look good. They're all negative. And that's data through March 31st. And again, that speaks to why in the models that we're managing, why our fixed income sleeve is 100% in cash. And it's been 100% in cash, I believe, since January 1 or a couple days into January, we reallocated that. Not sure the exact date, but that's why. So when we're managing money for clients, we're managing money differently. Hopefully, if you're a client watching this, you're pleased with what you've seen year to date. If you're not a client and you obviously want to chat with us about how we do things and how we manage money specifically, more than happy to do that. We are obviously continuing to grow. We're very pleased with the referrals that we've gotten from clients over the years, especially these last couple years. So if you're watching this and you're not a client, by all means, feel free to reach out to me. I'll put my information up on the screen in just a minute. So that just about wraps it for this month. Again, you do not have to be a client in order to ask questions. By all means, feel free to reach out to me, and I'm happy to answer questions, happy to schedule a time to chat. We do have the 2 offices in Southern Pines and in Cary, North Carolina. And then obviously we have a lot of people from across the country that dial in, and we meet virtually. That happens a lot more and more today. So one more plug for our Victory Ride fundraiser. Again, we're trying to hit $10,000. If you are able to help us in that regard, we certainly appreciate it. The instructions are there. And then if you aren't already, make sure you're following us on all the social media platforms. If you're on YouTube right now, please make sure you hit the like button and the subscribe button. And we appreciate that. Feel free to share these videos with anybody that you think would find value in these videos. And finally, the disclosure that we need to put up and remind everybody that the video is not designed to be a recommendation. It's really designed for informational purposes, trying to use technology to our advantage and communicate with our clients on a regular basis to let you know what we're seeing and what we're thinking from a portfolio management standpoint. We do believe in comprehensive financial planning, but we also believe that asset management is a really key component of a well-rounded financial plan. Again, if you have any questions, feel free to reach out. My contact information is on the screen. We thank you for watching, and we'll talk to you soon.